Let's bring in our panel to react to what we just heard. Steve Liesman, Paul McCulley, both still with us, along with our own senior markets commentator, Mike Santoli. Steve, I want to start with you out there in Jackson Hole. Your reaction.
Well, I have here what I've written down as 4 reasons why the Fed may cut and 1 reason why it may not. So it's 4-1 in that regard. It may cut because the current rate is moderately restrictive, because the labor market is unlikely to lead to high inflation. That's a pretty important point. He kind of has adopted Fed Governor Chris Waller's take on that. They're going to cut because the downside risks to employment have risen and because tariffs are likely a one-time price increase. I would say, reading that statement, maybe I'm missing one. The only caveat to all that is, obviously, he didn't mention this, but the data to come in the coming months, and that inflation expectations remain well anchored. So I think he's pointed us to a rate cut in September with just a few caveats relative to the data and inflation expectations.
Paul, you were right. I mean, you suggested before going into this that we would get a Fed chair that would hint at a September cut. I feel like that was the big takeaway.
Yes, it was. I thought overall it was a marvelous speech, kind of in the nature of a valedictory, his ace speech. He did what he needed to do, which was signal that the time has come to take the next leg towards neutral, which I think is about 100 basis points below here. So he did that and then left it to September with the FOMC to flush out the contours of what the whole path of recalibration 2.0 is. So I thought he did a marvelous job.
But he really did change his tone. I mean, Steve highlighted, he said it's a reasonable base case if inflation effects of tariffs, that inflation effects of tariffs will be short-lived. I mean, that really is coming around to the Waller-Bowman viewpoint and not something we heard from him before.
Yeah, I think that was important. That was important in that he was aligning himself more fulsomely than he has with that wing of the FOMC. And it was very, very clear that Mr. Waller has an ally.
Well, Mike, the market reaction was swift and sort of exactly what you would predict with the Fed hinting at the cut.
Yes. So banished the bit of doubt that had creeped into the market over the last several days that we would likely get this cut in September. And it also is manifesting in also the ways that we would have handicapped, right? I mentioned earlier, small caps, if you get reassurance, they're going to run. They're up almost 3%. Banks are running. Lower quality, like kind of speculative tech, is running. So that's right. That's the initial reflex.
Small caps,
and it's
2%.
Understandable. Yeah. And so once you have that reset, I think it does come back to, look, we are going to get a jobs report in September. We're going to have to calibrate exactly how this is going to fit into the outlook. He did, Sarah, say it is a reasonable base case that tariff effects are short-lived. However, he said even though they may be one time, they're not all at once. And so, therefore, it could filter in unpredictable ways to inflation. So I think that from the market's perspective, if you just look at history, when the Fed resumes a rate-cutting campaign after a pause of more than 6 months, it has tended to be bullish. Because usually it means they were waiting and they had the luxury of waiting because the economy hung in there, and then they resumed because presumably inflation didn't get out of control and they were able to kind of preserve the soft landing or the expansion or whatever it is. That being said, it's somewhat unusual to be getting cuts in the abstract based on where financial conditions are, considering crypto and IPOs and credit spreads and equity valuations. But that's not what their mandate is. And their mandate is we got a really ugly jobs report relative to the last time we really gave a detailed outlook. Yeah.